3, 2, 1. Welcome to the show.
All right. It is December.
It's another week. I know it's
another
December.
week. It's another month.
Another month. It's just fly by.
Yeah.
Santa Claus will be coming any time. I hope he brings his rally with him.
Let's hope the rally gets going for sure. We shall see.
We got a special show this week. We had an interview with our buddy Scott Zane.
Yep. Weekend of Thanksgiving.
Yeah. And so we saved it for this weekend because we're going to be out traveling and whatnot. So it's going to be a good week for it. And it's a pretty good interview. If you guys, we did an interview with Scott about a year ago.
Last December.
Yeah, and we're going to try to do it at least once a year because Jerry takes kind of the technical analysis viewpoint, obviously, anybody watches this show. And then Scott's a much more fundamentals guy. And it's great to get you two together and kind of give your perspectives on what's been going on this year, what maybe we're looking for, right?
Yeah, and so for a little kind of preview, at the end of the show, we pretty much come to the same place. I think we have some pretty serious concerns about what's happening both on a technical and a fundamental perspective in 2023. So hope you guys enjoy the recording.
Yeah. All right. Well, without further ado, is that what they say?
That's what they say.
That's what they say.
Let's hit play.
All right. Let's do it.
All right. Recording in progress.
Hey, Scott. We got an odd little setup here today to try to do the interview, but we're going to make it work. Thanks for all your patience. And it's cool to have you back again, man. It's been over a year.
It's been, yeah. I when I was first looking at it, I thought it was early this year, but I think it was last year.
I had no idea it was that long ago until you guys mentioned it. It didn't seem like it's been that long.
Well, we got to have you on once a year because you guys do a good
wrap-up. The wrap-up is pretty good. I mean, we're recording this here towards the end of November, and we'll talk about some of the stuff for the rest of Q4 and kind of going into next year and see what compare how you look at it and how we look at it, and see some similarities and differences and where people can take away some opportunities or some things to avoid. And, I sent you a list of some things I wanted to talk through, and so yeah, it'll be good. You want to just
a reminder, guys, too, that because we're doing this in Zoom, we probably only have about an hour or so.
Okay. Yeah. That's good to know.
Yeah, we don't want to go on for a couple hours. It might work. I don't know. We've never tried it this way, but our normal stuff wasn't working. So we kind of had to go old school, which I can't believe Zoom is actually old school.
Yeah, no, it is. Yeah, old school. Okay. So Mr. Scott Zane, please, if you could do a little intro for anybody who doesn't know you, and just like the Facebook groups that you run, and then we'll get into it.
Okay, so for those of you guys that don't know me, my name is Scott Zane. I'm retired Air Force aircraft mechanic. Different branch, those two clowns there. I drive a truck for a living now, and I run the main, I guess I would call it the main TSP, Thrift Savings Plan (parentheses TSP) group, and Thrift Savings Plan for Swing Traders group. And I started a separate page just so people could more easily find my personal content. It's called Zane Analytics. I also have a YouTube channel that I changed the name of to that as well. So I can always find my content there as well.
Yep, it's good stuff. I mean, I definitely am on your Zane Analytics page and watch your YouTube channel. So it's good stuff. Obviously, you come to things from a more fundamental perspective than I do, but I read as much as I can from everybody's different perspective.
And likewise, I sometimes when I'm able to watch your stuff, kind of get an idea of where your perspectives are, and so I don't cover so much on the technical stuff, but there are a lot of people who have interest in the technical analysis side. So I usually refer them to either your group or page or to my Swing Traders page. There are other people. Even you've commented in the Swing Traders group too.
Yeah. Oh yeah. Yep. You do have a lot of technical analysis guys in the Swing Traders group. Yeah. So awesome. 2022 has been quite a ride, right? I don't remember. So did you because you basically are earnings focused. So was there a way to not forecast, but did you have any concerns about 2022 at the end of 2021?
I did not. I don't recall. I actually show you some of that data in a little bit here, but yeah, I was still projecting upward. Actually, to this day, I'm still projecting upward on the earnings. We should be quite a bit higher on the prices, but with there's very valid concerns about recession though. So
now for sure, yeah. Getting all these things popping up on my screen here. Yeah, I mean, obviously from a technical perspective, the end of 2021, I mean, we actually hit a new high in the S&P within the first couple of days of 2022. So, there was no reason to expect a complete collapse in anything, other than if you do the Elliott wave count and some of the other technical analysis type stuff, you were anticipating some kind of top. Of course, there's no way to know that the top is there until it's in hindsight, right?
correct.
So then once it did start coming down, the price anyway, it's been quite a ride. So basically, how would you kind of define the difference between like fundamental versus technical analysis, which I don't know that everybody understands, but so if you can just kind of describe that, and then kind of relative to buy and hold versus active management and swing trading, because I think people get really confused about all that stuff.
Okay. Yeah. So fundamental analysis is just basically all about the earnings data and also the economic data in a way. Just ultimately stock prices follow the earnings, but stock prices also try to predict what earnings are going to do. So like what we have going on right now, earnings as a whole are still kind of going up, but I do expect them to flatten out. And but share prices on the stocks have gone way down, and that's because they're predicting doom and gloom. It doesn't necessarily mean that the doom and gloom will come.
Right.
If it never does come, you'll see prices rocket right back up to where probably in the neighborhood where I'm expecting them to be.
Where does the earnings say we should be?
Quite a bit higher. I can show you that right now. Host disabled participant screen sharing.
Okay. You have to enable share screen. Hang on one sec.
Okay.
Did that fix it, Scott?
Yeah, we're good there.
Good deal. Forever since I've used Zoom.
Okay, so this is the worksheet that I put together based on the pre-production communication between Jerry and I'd had this in other posts or videos of my own in the past. I just kind of put them together to kind of help illustrate, and I really needed to do this anyway. So what we have here, current value. See, I do have a gap there because I don't know what happened there between 2018 and 2021. My data that I had to work with, I just couldn't find it. So between second quarter of 2021 on to today.
Right.
So this CV is what I call current value. That's what I believe the index is worth based on trailing earnings only. Does not factor in forward expectations.
Oh.
These four over here are what the forward estimates are. So if we start with 2021 quarter two, my projection for that month was that quarter was 43.90 on the next quarter, but it actually came in at 43.25 instead. So it was a little bit below expectation. This one here as well, 45.55. It came in at 45.20, so a little low. But then it came in above expectations here. See, 47.20 came in at 48.15. So these look pretty, considerably higher. But kind of summarize. I guess it won't let me switch there. All right, right over here are my projections right now. The quarter is not complete yet. We're only projecting plus 2.5% earnings growth over the next year now, which is very flat.
Right.
So earnings have definitely suffered. And I got this chart here Kind of talking about price versus earnings. The blue line here is the price, orange is earnings. And see here, normally when they're going upward, the price is up above earnings because
Right.
they are trying to kind of buy up the expected price. But been sometimes where that declines, but the decline in earnings never come. So a little bit of a drop here. Very pronounced drop there on the price, but a little bit of a drop on the earnings, but not really enough to justify this kind of a drop.
So if earnings come down on that chart, does price necessarily move in one direction or the other?
Generally, the price is going to move before the earnings do. So, and like I say, it won't necessarily, the earnings won't necessarily come down as far as the price will. And sooner or later, when when sentiment gets more upbeat, you'll see the price rocket back up and should get back above the orange line eventually.
Yeah, it's an interesting. I mean, I spend all day looking at charts, and this is an interesting one to overlay the actual earnings with the stock price.
Yeah, and it's something. One of the sites I learned about fundamentals from. I'll full plug at them. It's Zacks.com. There was so much valuable information that I picked up from them. They're actually the ones who inspired me to create this spreadsheet, and because I track all of the S&P 500 companies. Those guys are just TSP participants. S&P 500 is the one that the C fund follows. Filters. So these are the companies that are reporting this coming week. I have two large ones here, Medtronic and Deere and Company. Could even show you what they're projected to do with earnings. Deere and Company, especially like there with their plus 35% earnings per share growth over the next year.
Right.
So for individual stocks too, again, follow the earnings. If they're especially if their estimates are starting to turn north, you're going to see their share prices also going north.
Yeah, in this environment for sure. Because I think everybody is downgrading earnings now, right? Or not everybody, obviously, but
actually, because I do my weeklies, and a large number of them have revised downward. I only look at the kind of, I guess, concatenate the ones that are $100+ billion companies, and I summarize those in my weekly reports to kind of give you a kind of general feel for how much of them are actually revising downward. There are some that are going upward on the revisions, but large part. Because the Fed funds rate going up, a lot of them are going down.
Yeah, I mean, especially the S fund is a problem, and now the C fund too, right? Because big cap tech and all tech, certainly the small companies, which is the worry about the zombie companies, right? If any companies that are debt funded, as rates continue higher, have a big problem.
Correct. Yeah, absolutely. It's a good point you made there. The ones who are running on, or who are able to run on completely cash, are going to fare better. Also, like smaller companies, they tend to rely more on loans, so they tend to get hurt a little bit more when the rates are going up. And then, when you see bond yields coming down, I would expect the S fund to outperform C fund.
Yeah, I mean, absolutely, because it's gone the other way this year because rates are going higher. So 100%. So how do you use all this data to, like, say, swing trade TSP?
I really just mainly, it only works when we're in rational periods. It doesn't work like right now when we're in what I call irrational times, but valid concerns.
As opposed to irrational exuberance.
Yeah. So normally what'll happen if we're in a more rational sentiment, I usually find that the price will stay inside this range right here. So if we were rational, I would say 48.10 on the bottom end and 49.85 on the top end based on existing earnings data.
Right.
But sentiment's not there, and for good reason. So I'm not surprised that the prices are down. But normally if I were to swing trade using this, I would go from C and S, or C and or S to G or F, whichever.
Right.
When the S&P 500 gets up to this range here, and when it gets close to 48.10, I would get back into stocks.
Right. Right.
Now, usually, I within about a percent or so of either one of those. So, it could be a percent or so below the top end, or the percent or so above the bottom end. Yeah, when I first started doing this, my brother-in-law was tracking how often either the S&P 500 or S&P futures would turn the corner relative to what my predictions were on this, and he counted 22 consecutive times that one of them retraced right inside that range that I was expecting.
Yeah, that's great.
It was crazy. Yeah. But yeah, then I started learning, I think in 2015, shortly after I retired from the Air Force, when we started getting into the, corrections, I think it was the Chinese economy, the GDP data that was concerning people back then.
Yep.
Yeah, we saw 10% correction, and yeah, I threw these out the window for a while, but it ended up coming back.
So what do you do now then? Like if we're in an irrational market, do you hang out in stock funds? Or you hang out in a G fund? Like what do you do if this methodology doesn't work in this market?
Ideally, I like to be able to get out and swing trade, because by nature I prefer to swing trade. But if I get stuck, I say it's already down, and my data here says it shouldn't be down, but it is.
Yeah.
I just stay in and ride it out. And even to this day, I'm still 100% S fund. I made that move back in March of last year.
Right.
And yeah, that's not really wanted to be. Like I say, I would rather be taking advantage of that drop and buying in low. I don't really care how much lower it gets, as long as I can buy back more shares than I got, then I'm still winning.
Right, right. In terms of shares, because you're accumulating shares.
Yeah, and I always want to make sure that I can buy back more shares than I've sold. I don't really care about how precipitous the drop is. The more the better, but only if I'm already on the sidelines waiting for it to drop more.
Yeah, yeah. That's an interesting thing that I didn't have on our list here, but let's just hit on that for a second. Okay. The idea of number of shares versus the dollar value of your account. If you come to TSP with the idea, like you just kind of explained, when prices are lower, you can buy more shares. So your number of shares is higher than it was, say, last month. But the dollar value of your account can also be lower, right? Correct. Even though you have more shares. So one way to do it, like the way I kind of look at it, I don't look at the number of shares that I own. I only look at the dollar value of my account. Because if I'm in the G fund, let's say, and I have $100,000 in there, as price comes down, I'm maintaining, G fund gains a little bit. So I'm gaining a little bit, basically maintaining flat, as the stock price comes down. And then if I move into the C fund, I'm keeping the same number of shares, right? But I'm buying in at a lower price. So the shares that I do buy are going up in value. So basically what I'm saying is I'm not keeping track of the share count as much as the dollar value.
Yeah. Now you're more experienced and like savvy on that aspect, but now your average person who's watching this is going to be just run-of-the-mill person. They just want to have a nest egg to live off of.
Sure.
They generally know nothing at all about investing or economics, or very little about economics. Usually recommend don't pay attention to your account balance, because what's going to happen if you're paying too much attention to your account balance is you're going to see a leak, and you're going to want to stop the leak, but you don't really know why it's leaking in the first place, and you don't know what it's going to take to fix the leak. And you moving out of your stock fund positions is not necessarily going to fix it. Actually, more often than not, you see the price drop, you get out near the bottom because you don't know any better, and you just happen to be looking around the time that it actually was hitting near bottom. and then the stock market experiences what you call a whipsaw effect. Now, I know Jerry and Conan are familiar with that term, but your average person doesn't know what whipsaw means, and yeah, you don't want to be watching the stock market shoot back up without you involved included in it, because when the prices are at or near the bottom, when they start going back up, that's where you're going to see the strongest daily gains.
Yes, for sure. Yep. Yeah, it's interesting because that's what we do. So there was, I don't know if you saw, there was an article that just came out within the last couple of days from was it Fed Weekly? Fed News Network, Federal News Network. And the title of it was something like investors should just not, it said to bury your head in the sand, basically. Just don't look at your account at all. And yeah, it did literally said bury your head in the sand. So I that made like the hair on the back of my neck stand up, because I'm sure you've seen this chart, right? The 200-week moving average, we bounced off that level at the bottom in October. And since 2000, since the high in 2000, the S&P 500 has hit that 200-week moving average line 8 times. Okay. 3 of those times, the 2001 crash, 2008 crash, and COVID crash. So 3 of those 8, the market went considerably lower. The other 4 times it found support. And then where we are right now, it's a question mark whether or not, we actually got support there. So if the market doesn't go any lower than it was in October, that will have been we will have gotten support at that level. So what I'm saying is we're at a critical line right now. If we get a close, say on the S&P below like 3,500, then the odds increase dramatically that we go much lower. As long as we stay above that line, we're in good shape, right? So I would argue that now is absolutely the worst time to bury your head in the sand.
I agree, because there are some signs of possible bottoming process, and on the economic data, there's still plenty of evidence of consumers spending their money, and I'm not seeing any noticeable upticks in credit default data. That's something I also look at and post when it does get updated. SP and Dices actually post that every quarter or something like that. I can't remember. But yeah, I check the SP and Dices website regularly because I'm also looking for constituent changes in the index, and that same link, that same list where I find the constituent changes, I also find the credit default data.
Right.
I don't know if you can see the chart right now.
Yes.
Okay, perfect. Because I was trying to illustrate what you were talking about to the viewers. So the blue line here is the.
No, I'm sorry. I can't. You still have the.
Oh. Let me switch because I had it set to share just that other thing, right? So. Okay. How about now?
It's black. Oh, okay, it's up.
Okay, so this is the S&P 500 chart for the viewers. Jerry was just talking about the 200-week moving average. I have it at on the weekly right now. The blue line here is the 200-week average. I only have it set to I think like 10 or.
Yeah, it looks like 10 years.
Yeah. So right here is where an example where Jerry's talking about where it hit the 200-week average and then it bounced. This was in early 2018. Yeah, this was 2016 right here.
Yep.
This came down originally because of oil. The oil prices they collapsed from like 106 or whatever it was a barrel down to like barely $20 or something like that.
Right.
And the energy stocks were single-handedly pinning down the stock market, the rest of the S&P, and then it went back up. Then you had another bounce off the 200 right here at the.
That was 2018. End of 2018. Yep.
You did
and then COVID
there. Yeah.
I mean, COVID, it did go below the line. I call that kind of a one-off, because if you could pull the chart back to 2000, you'd see the break in 2001 and then 2008. I mean, the market falls. Yeah.
I got a lot of noise. Let's see if I can do a little longer than that. I don't know.
If you can do a little bit. Can you do a log scale?
All right, here we go. All the way to 20.
Yeah, that's good. That's plenty far back. Can you do log scale?
Log scale? I'm not.
Logarithmic instead of regular price chart. Try style up there. Yeah, I'm
not really
it doesn't matter. It's easier to see the dramaticness of the price move. But so if you put your cursor back down there to the top in 2000.
That'd be right over here.
Yep, and you see the blue line, the 200-week moving average line. We came down, broke that line in a big way, came back up, rallied above it a little bit, and then rolled over again, and it just kept going down, right? And it took, a couple years there to get back up above that blue line.
Yeah, and in fact, even the high here after the .com bust only barely got up to where the high was at prior to the .com bust. Over here is where the housing recession or the Great Recession started and got even further down, but then that's when it started to recover.
Right, but you can see. So my point was that when you get below that 200-week moving average line, it can go much lower. I mean, that's really where in both 2000 and 2008. Once it got below that line, the decrease really started to accelerate. And now, of the 8 times, including the one that we're in right now, most of them got support at that line. So I'm not saying that we're going to crash through and price is going to go lower. This isn't a forecast. What I'm saying is now is the time to really pay attention to it, because if it does close below that line, even though you might be down for the year, if we get down there to say 3,500, below the lowest tick in October there, yeah, if we get a weekly close down there, chances are the odds increase dramatically that we go much lower from there.
On a technical level, I agree with you.
Yeah. So that's the only thing. Like, so articles like that say, bury your head in the sand. Just at this particular point, I think it's the time to really pay attention.
I don't normally look at the monthly chart, but just to kind of help illustrate that, because see, we actually might find some 10-month average is not really strong resistance, but we could find resistance there. You'd probably agree. And
yep.
Yeah, right now the 50-month average is at 35.62. So we could find, definitely some more support over there. But otherwise, the 100-month is way down here at 29.26. And that's just looking at moving averages. There's so many other things that technical traders might look at, like, Elliott wave, like you're talking about, or Fibonacci levels.
Yep. Yeah, we talk about all that stuff quite a bit. Actually, how much time do we have, do you think? He's telling me we got to kind of move along, because if I get pinned down on one thing too much, we won't get everything I'm trying to do.
No problem.
So I guess
it's my job to be the bad guy.
Yeah. No, somebody's got to keep me on track. Somebody's got to be watching the clock. So macro stuff, right? War in the Ukraine, inflation, recession, this idea of the Fed pivoting. Like, did you take those kinds of things into account?
On my earnings stuff, or just?
Well, I mean, do you only focus on earnings and that's what you use to make reallocation decisions, or do you kind of take everything that's going on in the world in context and then apply that to what you see in earnings and then make a decision?
I do try to be flexible and work off of the what might drive sentiment changes too. But I've seen so many times also where people freak out over something news driven, and then it turns out to be nothing. So a lot of times I don't worry about it. Like uh, Russia and Ukraine, there's so much going on there with that. Yeah, and it's actually trickled into the U.S. economy too, because now you get a lot of people who get on their political hobby horses, whatever, and start talking about our politicians here. But there's a bunch of other countries in Europe, especially, that have sanctioned Russia, are refusing to buy Russian oil because of what Russia's doing in Ukraine.
Yep.
Okay, they still need their oil. Where are they going to get it from? They're buying it more from the U.S. And if you watch my updates, I look at crude oil prices every single week. I'm a truck driver. I pay for my own fuel. I'm also interested in that for my own personal reason. And you can. There's a website, the EIA.gov website. Every week I pull the data off of that, and you can see that the national average price might do this or that, and sometimes even regionally, like. Kind of a more common trend lately has been, I think your area, the Northeast, that area and Central Atlantic are usually tend to raise more than the national average.
Yeah, it's definitely it's not as bad as California, but it's pretty expensive out here.
Yeah, but rate of change relative to the national average, yeah, you guys are getting hit a little harder, and I think that the Russia and Ukraine, because you're getting a lot of demand from Europe trying to buy American oil,
yep,
among other sources. So it's pushing up our oil prices as well.
Yep. Yep. Yeah. I just wanted to see how you fit all that stuff in. I mean, you focus on earnings. I basically focus on the technical side. But my sentiment, it's very hard for anybody to just make decisions based on either the numbers or the charts, because you get the news constantly in your ear on the one hand, which makes it now all the news is negative. It's all bearish. So it's very hard when I get to a decision point in a chart to cut out all that bearish noise and just focus solely on, if this line crosses that line, then I'm making this decision, regardless of what is happening in the world. So for example, like I got back into the I fund and the F fund a couple of weeks ago, and it's turned out to be, pretty good. The F fund one I had a hard time with, because we all know the Fed's going to keep raising rates. But the chart, the chart is telling us that right now, rates are coming down, and they are. It's just, but we also know, as the market goes up, when the Fed meets in December, I would expect them to be very hawkish, right? Because they're not going to like the fact that the market has rallied, because that's what they're trying to tamp down. So it's tricky putting it all in place.
Yeah. Now the Fed, their main concern is with inflation. They're not so concerned about what the stock market does. They only care about getting inflation where it needs to be. And actually, if I could go back to my, or no, I think that might be, is it the wrong one? It might be the wrong one here. Let me figure out which spreadsheet I need to work with. I think it's the other one. I'll try to be quick with it, but all right, yeah, it's the other one. I want to show inflation data and how I think that we don't necessarily need too much Fed rate hike activity to control this. Now, I do post this myself on my weekly posts as well. I post both the chart from tradingeconomics.com, and I put the same data in here. This is the same data you get from Trading Economics right here.
Okay.
And so it's showing what the point changes, the percent changes month over month. Year over year, we were at 7.7. I was actually projected 7.5, 7.6 myself. And, so looking out over, if I were to pull up the charts, which I don't got to, kind of, in the interest of time, I'm not going to.
Yep.
Looking at the current trend, though, it's kind of in this neighborhood. And I averaged out to 673
Right.
increase the CPI by 673 every month, and this is what we'd come up with. It would come down into the 2 to 3 range on its own without any help.
Yeah. Yeah. There's an ETF. Let's see if I can find it here real quick. Let's see. No, I know. There's an ETF called RINF. It's ProShares Inflation Expectations ETF. And RINF is the ticker symbol, and it has fallen off the cliff. So basically the market is agreeing with you that inflation expectations are coming way down. Right. So if you wanted to trade, to trade your data right there, you could do it using this ETF RINF. That's all I'm saying.
Yeah, and also on that topic there, because when inflation comes down, bond yields can also come down, and that's going to negatively impact the growth rate of G fund, but will actually help F fund.
F fund, yeah, right. That's another one that it's tricky for people because when the yield goes up, the G fund goes up, but the price goes down, and so the G fund price isn't like the F fund price, right? The G fund is based on is direct with the yield going up and down.
Sounds like a lost audio.
I can still hear you.
Oh, now I can hear you.
Okay. Yeah. So the G fund and the F fund can be a little bit tricky to understand because when yield goes up, that is the G fund. Your gains are from yield, but in the F fund, when yields go up, the price of the F fund goes down.
Yeah, and with G fund, to help further elaborate on that for viewers, G fund its growth rate is affected by all U.S. Treasuries with at least 4 years remaining to maturity. So it means only the 5-year, 7-year, 10-year, 20-year, and 30-year bonds affected.
Yep. Yeah, that's another odd one we actually talked about on the show last week. On the TSP site, it says that there's 181 Treasury securities that make up the G fund, and most they update it every month. So somehow the price of the G fund changes daily. The value, if you look at it, it gives a daily price, but in the definition of what the G fund is, it says it should be monthly.
Yeah, and then also if you're going to get kind of a ballpark idea of what the current G fund growth rate is, I don't know if you can do it on the new TSP website. I've only been on it like 2 or 3 times since they've done the change. But on the old site, you could go on to the TSP loan. Even if you don't want to do a TSP loan, just go in there, pretend like you're going to do one, set up like kind of going through the process, and it'll tell you what the interest rate is that you have to pay yourself back at.
Right.
Whatever that rate is about what the G fund's growth rate is.
Right. Yeah, I don't want to get into the new site, but it's a disaster.
Yeah, I'm not a fan of it either.
Yeah, it's a disaster. All right, let me see what else. So what do you think about going into 23? Recession is definitely the buzzword. It has been for a year, but it seems like going to 23, I'd be amazed if we get out of it without a recession. Fortunately, it doesn't affect us so much as government employees, but it certainly affects retirees and anybody who, isn't a government employee that loses their job.
Yeah, I agree with you. I'm concerned. I think we can get a soft landing possibly, but right now with the bond yield curve, it's like the short-term bonds are getting up above the long-term bonds, and I'm not just talking about the 2-year versus 10-year. I tend to look more at the 30-day and 60-day bonds.
Yep.
Because those tend to be extremely rate hike sensitive. Actually, the 30-day bond I especially pay attention to because it tends to predict what the next Fed funds rate is going to be.
Yep.
Whereas whereas long-term bonds are more just driven by regular like inflation.
Yeah, and that's unfortunately for us, we have the F fund, which is a combination of corporate and treasury bonds. It would be great. I mean, you can do this in the mutual fund window, but long-term treasury bonds, a lot of people think are going to do real well in recession. Before, as stock, because we should expect stock prices to come down during recession, and money start moving towards bonds, long-term bonds. But for all of 2022, the stock market and the bond market has come down in tandem and up. Any of these bear market rallies, bonds have rallied with stocks as well. So until we get a split and get back to normal, when stocks go up and bonds are flat to down and vice versa, it's going to be very tough.
Yeah, and the reason why that happens, because usually they go in opposite directions for the most part, but when they do go in tandem, it's indication of foreign interest in the U.S. bond market. Yeah, so stock and bond prices both going up. Well, us average Americans, we got to be taking our money out of one side and putting it into the other generally. But so where's the money coming from if they're buying into bonds? It's coming from foreign sources. Compare the U.S. bond yields to say the German Bundesligas or the other nations' bonds. You see that we're like way up, like 2% higher than what all of their bond yields are at.
Yeah. It's really important to kind of keep in mind that we're not in a bubble in the United States. People talk about gold and why hasn't gold performed if we have all these inflation worries and everything else. Gold in any other currency has done really well, but gold relative to the dollar, which is the only way we can buy it, has not done well. So having a kind of a global look at all this stuff is pretty important to kind of get all the way around perspective. Yeah.
Well, also gold is usually what people use as a hedge for when the value of the dollar drops, and the value of the dollar tends to go in unison with inflation. So as the value of the dollar soared, I know we don't have much time, so I'll just say maybe check out some of my weekly posts. I always talk about the dollar index value because it's kind of the elephant in the room right now. When dollar value is so strong, you can't expect that gold is going to do very well. But when the dollar value starts dropping, I would normally expect maybe gold or maybe even cryptocurrencies to perhaps do a little better.
Yeah, that was a big part of my iFund decision a week or two ago, was because I put up for our subscribers a chart of the dollar had seriously broken down through that 20-day moving average line, and it had been supported at that line all the way along for most of 22, and broke through it in a big way. And when the dollar weakens, the iFund goes up. So far that's worked out, but I don't think that I don't think we've peaked in the dollar. So
okay, so to help explain that to the viewers, the reason why that happens is that the iFund invests in two different things. It invests in the MSCI EAF index, or it's actually an ETF called EFA. But it also invests in the foreign currencies of those countries. Now I cover all the EAF index countries and when I do my monthly ISM, my PMI reports at the beginning of each month. So if you watch my weeklies, where you'll see that, you'll see in there how those countries are doing as well. But if you see the dollar value coming down, that's it's usually a better time to be focusing on iFund.
Yeah, there's all kinds of ways to play this game, and I'd like it when it's good talking to you and talking to anybody that comes to it from a different way when we agree. If we come to it from different perspectives and at the end of the day say, yep, under these conditions, I can still hear you.
Oh, no, I can.
Yeah. So it's always good to agree, because it's more likely that we're going to be going in the right direction.
Yeah. Now to kind of help on your technical side, how much time we have there, Conan?
You guys are doing good. I mean, we can't do another hour, but
okay. All right. I was going to pull up the chart again just so people can have a visual. I'll pull S&P 500 back up. I had that RINF there up a second ago. Okay, so kind of what Jerry was talking about here. We got to bounce off the 200-week moving average down here in October. Now, what happens here is once it breaks down below the 100, you might, because people can set up pre-set up buy and sell orders at whatever levels they want, and they can sit there in a queue for up to 6 months before they actually trigger. And so they might see that this 200-week average is right here, and they might have a bunch of buy orders put in place right there before it ever even gets to that point. And then when the price actually gets down there, the market makers see all those orders in the queue, and you get a surge in buy side demand, and that pushes the price back up. So this is why, why Jerry Conan always talk about technicals. I kind of glance over it a little bit. I mainly look at moving averages. I don't go as in depth as Jerry and Conan do, but yeah, moving averages at the very least are absolutely essential to look at.
Yeah. Yep. Couldn't agree more. All right. So 23. I guess we already covered that. We kind of agree. I'm certainly concerned. And so it puts my bias basically if the market's going up, I want to be in it, but I'm going to cut my losses super short. I mean, I'm not going to let it roll over, and take out any of the gains that I'd made. But that's just, it's basically trend following is the idea, and trying to use technical analysis to manage the trend. And it's a matter of the time frame you're looking at. Like when we do the weekly update show every weekend, where we put up weekly, like 3-year weekly charts. And so if you only want to track your TSP once a week, and make decisions based off of those moving averages, you can certainly do it. But then again, like you say, if we hit that 200-week moving average and have a big pop within a week, like we did this time here in end of October, beginning of November, you would miss that move. So it's a tricky, and then you got to factor in the two, basically have 2 moves a month, and then any additional move, you can only increase the value in the G fund, which is decreasing the value in whatever else you're in. And so it's a tricky game to play in TSP.
Yeah, it is. And then, adding that complications with the IFT limit, or whatever they call it now.
Right.
Even moving your money from the regular TSP side to the mutual fund window, that counts as an IFT.
It does. Only the first time, but yeah, it does count.
Yeah, once you're actually in the MF window and doing stuff already within it, it's not relevant. But yeah, moving back and forth between the MF window and TSP funds, those always count as IFTs.
Yeah. All right. I think that's all I got. You got anything you want to add? Anything we should talk about that we didn't?
Now, speaking of mutual fund one, I don't personally mess with that. There's too much. It's too expensive. It's not worth it to me. I'm more interested in futures contract trade myself. But for those of you guys who are TSP participants, or maybe even if you have IRAs or other 401ks, and you can, if you have the ability to invest in more than just stock and bond index funds, I do also cover usually my end of quarter updates. What each of the different sectors within the S&P 500 are doing, because the S&P, or any stock, it breaks down into one of 11 different sectors, and then those sectors kind of break down into their own smaller umbrellas. Yep. And I do tend to track what those sectors are doing, and actually I can kind of show you real quick on that. Find the right one. There we go. Actually, it's this one here. Okay. That out of the way. All right. So like over the last 5 quarters, the energy sector has been the strongest grower, but as you see, it's getting softer and softer because it's getting a stronger standard to compete against.
Yep.
Industrials looking good too. Um, right now, utilities is down at the bottom at -8.5% practically. So they could be a good contrarian play there, where you can buy into them and they might take off. And that's, but well, you don't want to see utilities up at the top because if
Right.
they're at the top, we're really in bad shape economically.
Yeah. Yeah, this is interesting stuff, Scott. I like it because we, Jerry and I tend to do. Well, we actually have a 401k for, for our company, and one of the reasons we did it is it has a brokerage window,
Yep.
and so we will trade in our 401k. We wish we could do this in the TSP. We have access to just everything, right? And so you can break out the sectors, and you can kind of dig in to what sectors are doing best. And I think Jerry does a little bit, not necessarily. That's not the same technique, but when Jerry does work in the mutual fund window, I don't.
Yeah.
And you've had a little success there.
Yeah. I mean, it's 28.50 a trade, so it hits you. You have it for me. Actually, I think it's a good thing because it makes you make a decision on purpose. Because every time you get in or out, it's 28.50 a trade, and so I'm looking at it, and I'm not gonna day trade inside the mutual fund window. But like I have a long TLT is the ETF. I can't remember what the fund is.
That's the 20-year Treasury note, if I'm not mistaken.
Yeah. TLT is a long-term Treasury ETF. I just can't remember. There's a fund in the mutual fund window that mirrors it. And so I've started nibbling back into that because I do think that as recession comes in 23, the long end of the Treasury bonds go up. And so there's things you can do in the mutual fund window that you can't do because we only have the 5 funds in TSP.
Correct. Yeah. Now, also on that note, because we're talking about like stopping the leak earlier. Okay, so a savvy investor is going to move from stocks to bonds, not because they're trying to stop a leak, but because they know that bonds at the time are a better investment, better and safer investment than stocks. So, like I showed you earlier, only expecting a 2.5% yield on the S&P 500 over the next year. Bond yields are up at like 4%. Well, which one's going to make you more money? Bonds,
right?
Okay, so lean more toward bonds. So that says put more of your money into bonds right now, just for that reason. And then when the stock earnings yields go back up, and bond yields come back down, now stocks look more attractive, and you make more money off stocks then.
Yep, absolutely.
Right. Yeah, but now I don't know if you guys have any issues on your side there with because it's pretty common where I'll get people on my groups where they'll ask about with their IRAs or whatever, what are some related funds that they can invest in, especially in an IRA. Now, IRA might as well be like the mutual fund window. You can break down into you can break down your investments into sectors or industries or whatever. You don't have to invest in stock index funds. And honestly, I think you're doing yourself a disservice if you're trying to match on IRA on your IRA what you're doing on your TSP, because you can do so much more. Who is it? That politician, the one who ran for president against Trump. What's his name again?
Oh, you got me.
Republican or Democrat?
Republican in the primaries.
Oh,
holy cow! I can't think back.
I want to say he's from Utah.
I can picture it, but I can't think of who you're talking about. Yeah.
Okay, well, this guy, there was a lot of hoopla because of how much money he's been able to make off of his IRA. And
Mitt Romney.
Yeah, Mitt Romney. There you go. Thank you.
Yeah, I could not think of his name. Yeah.
They all have the same contribution limits that the rest of us have: $6,000 a year for IRAs, or $20,500 for a 401k TSP.
Yeah. He was a Bain Capital. Romney. That's a whole long story.
Yeah, but
he rolled over a lot into that IRA.
Yeah, there's special rules for what he did. But sorry, go ahead.
Yeah, but he's also savvy, and he knows you can more finely focus your attention on things that are going to drive the, so like I mentioned, the S&P 500, 11 different sectors.
Yep.
Any given time, about half of those sectors are going to outperform the index. The other half are going to underperform. So if you focus your attention on the ones that are going to outperform, you can do even better. And then break down that sector into its smaller groups. Okay, which group is the strongest contributor to that sector itself? You can kind of narrow down your focus then, and but the more finely tuned, the more finely you focus your attention, the greater the reward potential, but also the greater the risk as well.
Yep.
Yeah, I can see a future show in the makings here, Scott, because the funny thing is like I hear you talking about it, and Jerry talks about the 11 sectors all the time, right? And how you can better take advantage of the market if we could get into those, right? And obviously we can, the TSP, but it would be interesting if you guys got together and just talked about that topic from those two perspectives, from your perspective, from fundamental analysis and how you track the 11 sectors and how they work versus what Jerry does with charts. That'd be pretty interesting, I think, for those that are listening to this thinking, well, how can I learn more about that? Because I think that'd be a great topic. Just that one thing,
yeah, it would.
It might not take a whole hour to do, but it would be fun.
Yeah, because I don't record too much what what each particular group does so much right now, but when I do notice trends, like when I just spot them when I'm doing my updates, which I do manually, I do tend to talk about them on my weekly. So I talked about airline stocks. They seem like they were doing well, and it's not surprising either because consumers are spending their money.
Yep.
There's evidence that they're spending it, but they're spending it all on services-based stuff like travel and things like that. They're not, they're going away from the good stuff. And then just this last week, we had mostly retail stocks, Target, Walmart, Ross, TJX, some others.
Yep.
Target didn't do so well from what I noticed. Walmart was, they actually beat what I expected and their earnings were still up. But then I actually noticed the more discount retailers like Ross and TJX seemed like they were doing better. I think they still had lower estimate revisions, but they just kind of gave me the impression they were doing better as far as the earnings expectations and data are concerned.
Yeah, it was all over Bloomberg for a couple of days about that. What the implication is to the economy. The idea on Bloomberg anyway was that high-end stores like Macy's and Nordstrom's and the other high-end stores are still doing well. Walmart does well because you go into Walmart and you get the things that you need, but Target, you go in and you can get the things that you need, but you also get the things that you want. But it's a lower end version of
I'm always walking out with things I did not go there for.
Yeah. So I don't know. I mean, I listen to Bloomberg all day and I got to stop doing it because it's almost getting to be as bad as CNBC. It's just people talking to talk.
But on the other note, though, when you see that kind of thing going on, you have to start wondering. It sounds like people are starting to pinch more on their money to where they can, and they're buying. Because when people are getting more money to spend, they're going to start shifting more from the discount stuff to the more middle, high end, whatever you want to call it.
Well, I think we are pretty close to wrapping it up because we definitely don't want to go over the hour with.
Yeah, I think we beat the hour. Oh, I got to turn my mic on. I think we beat the hour, but that's okay. We've had such a good connection. I don't want to take any more chances to of going off. And I hope you stay nice and warm out there, Scott, while you're roaming around the country. Keep us updated, and we'll keep watching your stuff.
Great. Yeah, that was great talking to you guys.
All right, buddy.
Thanks, man. We'll definitely catch up in the near future, and we'll get on here and do another one.
Yeah, sounds good.
All right. Cheers, buddy.
Later.
All right. See you guys.
See ya.